Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. Got a great program, some great guests. Bruno, welcome from Canada.
Thank you. Good to be here.
Is that your new office, Bruno?
It is.
Nice.
People typically congratulate me on my plant, but you can do that. It's okay.
All right, Ramsey, tell us, who do we have and what are we going to talk about today?
All right, Paul, thank you. Always glad to be here. So we're very fortunate to be rejoined by two of the most important voices in the retirement space, David Blanchett and Michael Finke. So both of them we've been fortunate to have them each of them on the show at least once or twice, and they can be seen very frequently on LinkedIn and in many other venues and in webinars, and we'll hear at the end what their next appearances will be. We wanted to bring them back on the show primarily because they've been posting a lot lately about sort of different trends in the space. And so with that, I want to welcome David, who is the head of retirement research at PGIM, and Michael, who is professor of wealth wealth management at the American College of Financial Services. So welcome back to both of you. And let's just get into it. You've posted on so many things. What are the two or three areas that you think are getting the most intense or should get the most intense scrutiny right now in the retirement space? David, we'll start with you.
Well, Mike, I was going to say, the one thing that I've been.
All right,
I'm going to go first. Yeah, you called on me. Thanks for playing. All
right, sorry.
So the one thing that I would just say is that, and we were talking about this before we started, is just the impact that the rise in bond yields are having on products across the annuity landscape. Just because, if you think about the way that a lot of these products are built, it's built using bond yields. There's more there, but so when we've seen this dramatic rise in rates, there's just been dramatic improvement and change in kind of the efficacy of products. And so I did a lot of research talking about like RILAs and fees and just a whole host of products last year. It's kind of irrelevant now. Like I need to kind of dust off everything I used to do because like the marginal value of a lot of these products issued by life insurers really have, I think, are a lot better, a lot sexier maybe than they were, say, even a year ago.
Michael?
Because this is something that I've been giving some thought to recently, and that is that you and I have both done research on FIAs. Basically, the long-term performance resembles that of, let's say, a corporate bond over time. And we both have discussed the fact that FIAs are, in some sense, like a bond substitute within a portfolio. This year really illustrated a unique aspect of FIAs that I don't think people really have given enough thought to. And that is that although they capture much of that term premium and a little bit of the credit premium over time that you would get from corporate bonds, they don't suffer the same losses that corporate bonds suffer. So let's just take a moment and reflect on how well, for example, the long-term corporate bond Vanguard ETF has done in 2022. If at the very beginning of the year you decided, hey, interest rates are really low, I'm going to try to eke out a little bit of extra return from my bond portfolio by taking term risk, I'm maybe also going to take a little bit of credit risk, I'm down 30%. In fact, that ETF is down more than 30% in 2022. If you had instead decided to use a FIA as a bond alternative, the guarantee would have looked similar to the expected return on those bond ETFs, but you have that principal protection aspect. Now, why is it that you get the principal protection aspect? Well, the insurance company is investing in those bonds. And so the insurance company, in its general account, has experienced a market loss in that bond portfolio that you don't have to bear. In fact, the insurance company has taken some of that volatility of the bond portfolio off your plate while still offering in the long term similar performance on the bond portion of your portfolio. That fact that the insurance company is willing to bear that risk and not transfer it to you as the holder of the fixed indexed annuity, that is a significant portfolio benefit of incorporating FIAs versus using, using them as a substitute for longer duration bonds in a portfolio.
Yeah, it's been, I will tell you, this has been a wild ride. And even if I looked at, what was the story of the first or second quarter versus third and fourth, David, Michael, it's been so different. A lot of products put in, as you know, low volatility indices, sort of do even the best or the best. Hey, we're going to give you a steady return or better than the market over a period of time and not provide those bumps. Now, of course, the markets behaved very differently, in the last 18 months going into sort of first and second quarter, because the most volatile stocks were the ones that were producing the biggest returns. They were taking out a lot of these vol controls. So I personally took a lot of calls and chats from clients who started to look at the statement and said, wait a second, the S&P's gone up this much, and you're only giving me this much. We were all sort of rubbing our hands together saying, what are we going to do? Now, the minute the market crashed, Michael, those calls stopped. And in fact, I, go out on a bike ride and find somebody I know from a long time ago, and he says, Paul, I love my annuity. I love my annuity with the market going down. So it really has reinforced a huge, part of the value prop of a fixed index annuity. I guess my question will be, is this temporary, or is this, a more permanent shift in how people are looking at these products? David, what's your
Go ahead.
I think it depends upon where rates headed. And I have no clue. If you had told me we'd have rates where they are right now a year ago, I would have laughed in your face. But that's absurd. I think that the one thing that I think is interesting right now is, this is to Michael's point, is like, people are really negative about surrender penalties and things like that. Well, insurers are sure, as long as the insurer can hold those bonds that they use to hedge the risk to maturity, that's okay, right? People are like, surrenders are so bad, but they're really not. Like, they allow individuals to have access to certain premiums they couldn't access otherwise. So, Michael's talking about fixed index annuities. What about a MYGA? I mean, a MYGA is just like a bond that's, maybe it was offering 3 or 4%. It didn't get marked to market. So I think that, a lot of the aspects that people might not love about annuities historically are really maybe going to change. I hope we're in a longer rate environment forever, because I think it creates a lot of really cool products, a lot of interesting innovation moving forward that we wouldn't have if we're in a low rate environment.
Hey, while we're on that topic, David, can you discuss a little bit about on the value of the lifetime income features on every single one of those vehicles, and the impact that the market has had on those particular riders and benefits?
So it's complicated, right? So I think that like certain annuities that provide lifetime income are more market responsive. So like SPIAs, I've got a piece of research I'm working on right now with CanX, like looking at like how payout rates for SPIAs and DIAs evolve over time, like very market responsive, right? Other products maybe a little bit less, but like collectively it should all go up. Now, what's interesting about the value of guaranteed income is that it's worth less the higher interest rates are versus self-annuitizing, right? Because you can actually generate more income from just holding tips today, just for example, right? But the thing is, I think that is actually outweighed by the behavioral benefit that you get today from buying annuities that pay out much higher. I think a lot of people were saying, I'm going to wait to buy an annuity until rates are higher. Michael and I were everyone was telling the story, well, they're actually worth more when rates are lower. No one could buy them. But I think now we have actually entered a space where technically, the value of the guarantee is less, but there's less behavioral barriers to actually buy the annuity because payout rates are just so much more attractive.
I mean, the other aspect, Bruno, is if you would have retired, as a lot of people did at the end of 2021, and you had some sort of a lifetime income benefit on a variable annuity product, then imagine someone who didn't have that benefit, how they would be thinking about what to withdraw from their investment portfolio over the course of 2022. If their investments are down by 20% and they have already been withdrawing, say, from $1 million portfolio, you started with $1 million, maybe now you have $775,000, maybe less. You hoped that you could withdraw $50,000 a year from your $1 million portfolio. Now you're significantly lower. The risk of withdrawing that $50,000 a year is significantly higher than it was at the beginning of the year. will you cut back? Will you go back down to $45,000 or $40,000? That's the true risk of not having that income benefit. If you have the income benefit, you don't have to worry about it. I'm just going to keep withdrawing $50,000 from that investment portfolio in the face of whatever headwinds I'm, experiencing. All investors are experiencing, and it may mean that I deplete my account faster, but that's okay. That's what that money is there for. And that's why I also think it's incredibly important at the beginning of retirement to establish how much of your portfolio you want to use for lifestyle, because then you don't feel bad about the fact that you've depleted the account if you have a lifetime income benefit. It's just part of the strategy. And the question is, if you don't have that benefit, what does that imply in terms of lifestyle volatility? You have to be very flexible.
I mean, that makes a lot of sense. I mean, the two of you have been very vocal on the sequence of return risk, which is basically what you just explained. How should new retirees view this risk in the light of this new economical context?
Well, I think we'll be able to tell you the answer to that about 30 years from now, right? I think that there's been a lot of great studies done using historical long-term talking about, I mean, here's the thing we don't know. We don't know where markets are headed. I mean, maybe Michael does because he's like really smart, but I don't know. And so what if this is just the beginning? What if equities just go down for a decade, right? Like this literally could be the perfect poster child for sequence risk, and that bonds are down, stocks are down, inflation's up. You can't pick a worse environment. Like, okay, there have been periods where a 60-40 portfolio has done worse, but it's hard to find an environment where inflation has been where it is right now and stocks and bonds are both down. So I think that, to me, one thing I have said, this is kind of a gut check, I think, for a lot of retirees where, maybe if you haven't enjoyed your experience so far, things would always get worse. I'm not convinced that, normally I would say we'll stay the course, but I don't know. One thing I do know is that, if you're an advisor out there listening, and you've got clients that have not enjoyed, 2022 so far, maybe it's time to ask this question, well, is it worth insuring part of what's left to ensure if things do get worse that my clients have locked in now today a lot higher income, right? So there is this effect where if you buy bonds, you kind of hedge the income, and that if when bonds go down, interest, payouts go up. I think now is the time it's worth reassessing. Is a investment-driven strategy working, and if not, what other options are out there?
So how are your various audiences responding to that? So, both of you are out speaking at conferences. You've got webinars. Typically, like the composition of those audiences, is it more insurance agents? Is it more fiduciary advisors? Who are the various constituencies you talk to, and how are they responding to these changes? And I assume it comes out in the Q&A. Yeah.
I presented two presentations at NAFA, which is a fee-only advisor conference. I presented at NAFA maybe 4 years ago. I had some similar messaging in both presentations, and I will tell you there has been a sea change in openness towards the use of annuities among fee-only advisors. There's an increasing recognition that if they're going to be a fiduciary, they at least have to consider the use of annuities. It's not just something that they can exclude and feel like they're always going to be making a decision in the benefit of the client by excluding annuities. And then I also see statements such as, I was just going online to a certain famous investment advisor's site, and he had the quote on his site that there's nothing that you can do with annuities that I can't do with investments. And there is not a single economist who studies retirement income planning who would agree with that statement. It's just demonstrably false. That attitude pervaded, I think, this industry in many cases, especially the fee-only industry. That attitude has gone away as far as I'm concerned. When I'm giving these presentations, I'm seeing a new level of openness. And it is really reassuring to see. I think, both David and I come from a background where we have worked with investment advisors who are compensated based on fees. We do have a very fiduciary mindset, the F word, but we want to make sure that when advisors are making decisions, that they're making decisions that are going to be in the best interest of the client. And we've been arguing, obviously, for a long time that getting rid of this idiosyncratic longevity risk is an important part of retirement income planning. People can live better if they do it that way. I'm seeing a change, frankly. It's reassuring, and it's great that the message is getting out there. But it's also a message that needs to be couched, and it's something that I think the insurance industry, and I'm sure we've talked about this in the past, but to the extent that there can be consistency in terms of sales practices and messaging, and I'm also seeing in the insurance industry that they are hiring people who deal with these types of advisors who are really experts on how to use annuity products efficiently for clients. But I think that the industry as a whole really has harmed itself in many ways by not reining in some of the more abusive sales practices that we continue to see, and it's going to continue to color people's impressions of the industry.
Yeah, I mean, so I would say I'm seeing this as Michael, and the one point that I make to people when I talk about annuities is like, I'm not suggesting that all of your clients need an annuity. Maybe it's less than like 5%, but it's not zero. And I think that far too many advisors that are doing retirement income planning, it's the number of their clients that have any kind of product that provides guaranteed lifetime income is zero. And so I think the goal is to kind of get them to kind of more actively consider it. And I do feel like we're making positive steps, but to be honest, we haven't made the steps I thought we would have 5 years ago. Hopefully the next 5 years is better.
All right. So before the call, we touched briefly on the 4% rule, and that discussion is a very regular refrain on this show. So wanted to get a sense for sort of what your both of your recent thoughts are on the 4% rule and its role in the personal financial management discussion.
Well, Ramsey,
I'll start with you, Michael.
Yeah, I just gave a presentation at PIMCO, and at the very beginning of the presentation, there was an introduction by Richard Thaler of the topic of the 4% rule. And his introduction was, well, everybody knows that the 4% rule is dumb. And Richard Thaler, by the way, is a Nobel laureate, the father of behavioral finance. And his impression of the 4% rule is pretty much consistent with the way a lot of us have thought about it for a long time. It's not so much that it was the original conception was dumb. In fact, they made a very good point, Bill Bengen, when he wrote the paper, and that is you can't simply rely on average returns to estimate what a safe withdrawal rate is. So he used historical United States returns, et cetera. And one aspect of the 4% rule that got picked up was this idea of a fixed spending amount from a volatile portfolio. You simply can't do that. You can't have a fixed spending amount from a volatile portfolio because the portfolio will rise and fall over time. And if it falls over time and you get a decade, for example, like the one retirees may be facing that retired in 2021, the reality is that they're going to have to cut back on their spending. And that led to some different variants of the 4% rule that created guardrails to allow clients to adjust their spending upward or downward. That's probably a more realistic approach to trying to develop a spending plan from a volatile portfolio. But again, it also doesn't address this idea of longevity risk. And it doesn't really say anything about what happens when you fail. People run these Monte Carlo analyses, and maybe you have an 80% chance of success, but there's no information about how bad things can get when you're one of those 20% of retirees who experience failure. And so economists like to use something called a utility analysis, where it recognizes that, yes, if you fail to spend $80,000 a year, but the downside is that you're spending $70,000 a year, that's okay. That's a much better failure than having to go from $80,000 to $30,000 a year and live off Social Security. So the gradation of lifestyle is what is captured by using a utility analysis, but it's a little bit less easy for advisors to understand the output. It can optimize, but it can't necessarily show you a very compelling, evocative statistic like a failure rate. But that failure rate really neglects a lot of important information that should go into the retirement planning process.
Well, it seems to me that like the way that the rule is used, and I'm being, this is a rough way of putting it, but it's sort of described in a very linear way. And what you're talking about is the utility function has a curve to it, right? And to your point, yeah, going from 80 to 70 maybe means, right, fewer trips to the golf course, but going from 70 to 30, right, means, a lot more essentials are at risk. We had William Bengen on the show some number of months ago, and one of the things that was really remarkable is I think that he would find common ground with you on many of the things you said. He talked about spending control as sort of a fundamental underlying element that isn't talked about enough. The 4% rule is, I think my view is it's a really good benchmark and a good place to start a discussion. And unfortunately, it has been sort of overutilized it's been used dogmatically in a way that I don't think it was ever actually meant to be applied.
So, real quick, all it tells you is how much you need to have saved when you retire. It's really, you just need 25 times your income goal. That's all it's ever intended to do. I think that advice is still a decent rule of thumb. It's obviously not optimal for everyone. I think the larger issue, as Michael points out, are the underlying assumptions that have been used in that model and other models as well that still permeate that advisors use today. And I think that, using some of those assumptions can lead to radically bad advice for advisors who are doing these financial plans for individuals when focused on things like the probability of success that totally ignores the magnitude of failure.
Well, and maybe we could talk a little bit about, advice in this period of time. I think of all the rules that we've talked about, things like don't try to time the market. Well, should you try to time the interest environment, right? The interest rate, right? Should I try to time the guaranteed income market? I never would have expected we'd see such change, David, we talked about earlier, in income, interest rates. And just to give you a little bit of color, we've had so much activity, as carriers trying to keep up with rates and deliver, value for consumers and agents. At the same time, agents have used this, and advisors are using this opportunity to go back and say, you were in this product, you were in this plan, we'll move you to here. Carriers, there's tremendous backlog in carriers. A lot of the money is coming from retirement accounts, investment accounts, and they may have started a conversation with their advisor 2 months ago. The money hasn't transferred yet, and the balances are down. So we're in this really strange hurry up and wait. What would your advice be? And I'll ask David and Michael, to advisors who are in that transition point at this moment with a client, trying to move them from a market-based, from a equity exposure into a guaranteed income space.
So the one thing that I think is a bit different now versus like where we were in early 2020 is that there weren't necessarily very good, safe options then. Now you can get MYGAs yielding 5%. The caps on fees are spectacular. I think that I always worry about investors staying the course, right? But it's always kind of door A, door B. Do I stick with the balanced portfolio, or do I move to something else that's maybe more secure? Well, now I do think it's worth having conversations to say, hey, the markets might rally. They have rallied so far. They might rally last month. They might rally, might go down again. How do you feel about your current strategy? And I think that now more than ever, it's worth advisors understanding where these products fit, because what worries me is that someone looked at a FIA a year ago and they hated it, and they don't realize how the market has evolved radically over that last year.
Yeah, and if you're thinking in terms of timing interest rates, it's not a bad idea to look at where the yield curve is right now, because the market's telling you what the expectations are for interest rates going forward, and it is that they will fall. It's not a perfect predictor of interest rates, but the 10-year is significantly lower than the 1-year or 2-year treasury. So it's telling you that the market is expecting this to be a temporary short phenomenon of high interest rates to sort of slow down the rate of inflation. And as a retiree, you can take advantage of these. If I just looked at 5-year MYGAs yesterday, and they were 5.2% from high quality insurers. If you can lock in your 5-year liabilities using a 5.2% rate, retirement income is a lot less expensive than it was a year ago. If it's good enough, if that will help you meet your liabilities, your expected liabilities in retirement at a much lower cost, it might be worth locking those in today. Who knows? None of us know where interest rates are going to go. But this really is an asset liability match exercise. That's what retirement income planning is all about. And right now, it takes fewer assets to meet those spending liabilities. Now, the liabilities may have gone up also because of inflation, but it's a lot of people have a mix of inflation-adjusted and nominal liabilities. For example, in Texas, my property taxes after I retire are going to be fixed, so they're going to be held constant. That is a nominal expense. That's a nominal liability. I can get rid of that with a nominal investment. I can delay Social Security to deal with my more inflation-adjusted types of expenses. But it is all asset liability matching, and the market's giving you a lot more these days than it did in the recent past.
Oh, while we're on that topic, I know one of the critics to lifetime income, to protected lifetime income, is the inflation protection. What do you say to those folks who would go against any protected lifetime income just based on that inflation factor?
I would say that, again, it's different in every country, Bruno. But in the U.S., we have a Social Security system that is explicitly linked to inflation, right? So, and I think that you have a set of real or inflation-adjusted lifetime income. To Michael's point, not all of someone's liabilities have to be matched to inflation. So I think that, yes, it isn't like the best thing in the world that you can't buy the explicit inflation hedge with other guaranteed income, but there are an emerging set of products that exist today that do provide at least an implicit hedge, where there's a possibility of a benefit rise if inflation is higher. But I guess if every American didn't already have lifetime guaranteed income explicitly linked to inflation, I would be a lot more worried about it. But I think that when people make that argument, you need to view the liability and the assets in their entirety versus in isolation.
We should also mention that there is some product innovation in this space. That, for example, F&G has come out with a fixed index annuity that does have a 5% inflation increase in the amount of guaranteed income that you can receive. So it's really the first fixed index annuity that I've seen with some sort of an inflation-linked income benefit guarantee. Be great to see a little bit more innovation in that space, I think.
Yeah, it's very expensive at this point, Michael. To come out with a product with value. You want to sell it when there's not inflation. It's a very expensive one when we're in the middle of it. But your point's well taken. So Ramsey, where does this leave us?
So, look, as always, this has been a great discussion. I think it would be great to get a sense for where people can see you in the near term. Webinars, appearances, as that you've been posting very prolifically on LinkedIn, a lot of important stuff. Where should people look to hear your latest going forward? Go ahead, Dave.
Yeah, so I would say that if you want to follow me, the best place is LinkedIn. I'm pretty active there. But yeah, so I usually share hot thoughts. I'm pretty honest. I'm always willing to engage in a good conversation too.
I think you're right. You can follow me on Twitter at Finke on Finance, and we have a podcast, David and I, and I'll have a link to our podcast both on LinkedIn and Twitter. You can give it a listen if you'd like.
Yeah, terrific. We'll put the links to all that in the show notes if you're listening. You want to find them. David, thank you. Michael, thanks for your time. It's great to have you on here. We enjoy following your work and dialogue and stuff you support in the industry. So thanks for what you're doing. And Bruno, Ramsey, thanks for hosting this. And join us again next week for another episode of That Annuity Show.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.